All right, let's talk Toll Brothers. Today we're digging into their latest earnings call. Now, on the surface, this was a classic mixed message. But the real story, the one that actually matters, it's always hiding between the lines of the financials and what management is really trying to say. So let's get into it.
So right out of the gate, you've got this head-scratcher. Toll Brothers came out with revenues that were better than anyone expected. That's great, right? But at the very same time, they missed on their earnings per share. This beat and miss thing immediately throws a wet blanket on the results and sets this really confusing, cautious tone for investors. So here's how we're going to break it all down. First, we'll look at that mixed bag quarter itself. Then we get to what is absolutely the main event, the guidance for next year. After that, we'll check out management's new defensive playbook, see how the street reacted, and finally, we'll give you our take on what to watch for on the next call.
Okay, so let's zoom in on that fourth quarter. What did the numbers actually show that had everyone scratching their heads?
Here are the big ones. Revenue, $3.42 billion. That's a solid beat, no question. But then you look at the earnings per share, the EPS, $4.58. That's a miss of about 30 cents. Now, management chalked it up to a delay in a big asset sale, a timing issue. But for an investor watching the ticker after hours, an excuse doesn't really matter. A miss is a miss. And this was the first real red flag.
And this is where things start to get, well, a little ugly. When you look under the hood past those headlines, the picture gets a lot cloudier. Net signed contracts, that's your crystal ball for future revenue, they were down almost 5%. But the really worrying part, the backlog, that's homes they've sold but haven't delivered yet. The value is down 15%. And look at the number of units in that backlog, down a staggering 22%. That is a massive signal that the pipeline for future revenue is shrinking and shrinking fast.
And that shrinking backlog, it leads us right to the main event of this whole call. Yeah, Q4 was interesting, but the real drama, the thing that actually moved the stock, wasn't about the past. It was all about the forecast for the year ahead.
In this chart right here, it tells you everything you need to know. Wall Street analysts were modeling for Toll to actually grow its earnings next year to around $13.83 a share. But when you do the math on what management actually guided to, the implied number is only about $12.36. That is a 10% plus gap between what the street wanted and what the company delivered, a total reset of expectations.
So where's all this weakness coming from? Well, it really boils down to three things. First, they're planning to deliver fewer homes next year. Second, their profit margins are getting squeezed. And third, their day-to-day overhead costs are going to take a bigger bite out of their revenue. Now, the good news is the balance sheet is still rock solid, but the operating forecast, that's clearly pointing to a much tougher year.
And this quote from the CEO, Doug Yearley, it just sums the whole thing up. He was crystal clear on the call. Their forecast is built on the idea that this choppy housing market stays just as choppy. It doesn't get any better. This is what we call kitchen sinking the guidance. They're basically telling Wall Street, look, we're setting the bar low on purpose so that hopefully we can beat it later.
Okay, so given that gloomy outlook, what's the plan? How is management actually planning to navigate these choppy waters? What's their playbook?
They're really going back to basics with a three-pronged approach. First, double down on their core strength, luxury homes. Their affluent buyers are just less sensitive to high interest rates. Second, they're simplifying the company. They're selling off their apartment division to become a pure-play, high-end home builder. And third, they're not just retreating. They're still looking to grow their community count to grab market share wherever demand is still strong.
And that move to simplify the business, it comes with a pretty nice payday. The sale of their apartment business brings in $380 million. That's not small change. It makes an already strong balance sheet even stronger, and it frees up a ton of cash to either put back into the business or give back to shareholders.
So you've got all this news swirling around, a revenue beat, an earnings mess, really weak guidance, but a clear defensive strategy. How in the world did the market put all these conflicting pieces together?
Let's just trace the journey of the stock price. Right after the announcement, boom, it gets hammered, dropping over 4% in after-hours trading. But then something interesting happened. As people had time to actually listen to the call and digest the full context, the stock started to claw its way back. By the end of the next day, it was only down about 1%, a big recovery.
But the price only tells you part of the story. Look at the volume. We're talking nearly double the usual amount of trading activity. That massive surge tells you that a lot of big decisions were being made.
People were selling, people were buying, and big funds were repositioning themselves based on this new, more conservative reality for the company.
And the financial media, they picked up on this right away. Barron's absolutely nailed it when they said the quarter was mixed, but the real story, the problem, was the outlook. This just confirms it. The narrative shifted almost immediately away from the Q4 results and focused squarely on that disappointing guidance for next year.
All right, let's put a bow on this. Based on everything we've seen, the numbers, the guidance, the strategy, here's our take on what comes next.
So here's our thesis in a nutshell. Management has effectively de-risked the stock. By putting out that super conservative guidance, they've lowered the bar so much that it should be pretty easy to beat. That probably puts a floor under the stock price. The problem is, there are no obvious reasons for the stock to go up either. There are no near-term catalysts. The story here has completely shifted from growth to just stability.
So with all that in mind, our official rating on Toll Brothers is market perform. We think the stock is probably going to be stuck in a range, trading sideways for a while, as the market just waits and watches for new data from the spring selling season. The one metric you've got to watch like a hawk is net signed contracts. That's going to be the first real clue as to whether management was being smart and conservative, or if things are actually worse than they let on.
And that brings us to my favorite part, the outrageous but plausible trade idea. Given this whole setup, how could you actually play this?
Okay, so the play here isn't about betting on the stock to soar. It's about betting on that stability we just talked about. One way to do that is by selling cash-secured puts at a price that's below the stock's recent low. So what does that mean? It means you're getting paid a premium, a little bit of cash, for basically promising to buy the stock if it drops below that floor. It's a bet that management did its job, the bad news is out, and the stock isn't going much lower.
And of course, we always have to end with this. This is not financial advice. So there you have it. That's our breakdown of the Toll Brothers call, where the real story wasn't the quarter that just happened, but the very cautious, very strategic setup for the year to come. Thanks for tuning in.